Today is Monday, October 28th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, Alan Bush, ADMIS Senior Financial Economist, and Mark Bowman, ADMIS Senior Global Market Analyst. Starting with the financials this morning, Alan, we're just about 2 weeks away from the U.S. presidential election. How will the election affect the interest rate futures markets?
Okay, well, regardless of who wins, it is expected that government spending will continue to increase, possibly at an accelerated rate. So this obviously is very inflationary. So anything that increases inflationary expectations tends to more adversely affect treasuries at the long end of the yield curve, and to a lesser degree, futures at the front end of the yield curve. So it is the treasury bonds that are most likely to come under the most pressure and underperform, while futures at the front end of the curve are more susceptible to easier policy from the Fed and other central banks. So with central banks on a course of easier credit conditions, I would expect futures at the front end of the curve to hold up relatively well, but futures at the long end, namely the 30-year Treasury bond futures, will probably perform the worst and will, I think, very much underperform relative to other issues. So look for the futures at the front to hold up, futures at the long end, the 30-year bonds to very much underperform the other issues.
All right, we'll be watching that. And Alan, what other major economic reports are scheduled for this week?
Okay, on Tuesday, we'll have the October Consumer Confidence Index guessed at 99.1. Wednesday, we'll have the third quarter gross domestic product. That's expected to be up 3%. And on Friday, we'll have the jobless claims. In fact, that's Thursday. Jobless claims Thursday, anticipated to be 235,000.
Thank you, Alan. Mark Bowman, the cocoa market. Are we finally breaking out of a consolidation pattern here?
Well, it seems that way. December cocoa did sell off last week to its lowest level since August 5th, and this did push us to the bottom end of the range that it's held for 2.5 months. And maybe was close to approaching the May 20 low, which was roughly a 50% retracement of the rally to all-time highs in April. So we got kind of this, we're pushing towards the low end of this range for a change. We also fallen below the 200-day moving average for the first time since this December contract started trading. It seems like we're at the reckoning point for the 24-25 crop. There was a report over the weekend that this is a little bit bullish thing. Pod counters in Ivory Coast lowering their expectations for the main crop because of too much rain they received earlier in this month that caused bigger flower and Shirel mortality. Shirels are small pods in their October counts versus September. And this has cost them to, they say that if the weather remains that way, unfavorable, the harvest could only reach 1.3 to 1.35 million tons versus previous expectations of 1.5 million. You know, decent hopes that this year is going to see a decent recovery after a very poor crop last year that came first off of too much rain last summer, the previous summer, and then that extreme hot and dry that came last winter. Still, port arrivals in Ivory Coast were strong again this week, 92,000 tons as of Sunday, which is up from 57,000 for the same week last year. And cumulative arrivals since the year began on October 1st, reaching 285,000 tons versus 170,000 this time a year ago. So that's up 25%. And this has also been the highest in 4 years. We had 204,000 at this point 2 years ago and 277,000 3 years ago. So, but we've reached a point where rain in West Africa could be more bullish than bearish. And we could see a bounce this week after the sell-off last week. But again, this consolidation pattern seems to be breaking down. Next support level is around $6,000 even.
Mark, looking at the crude oil market, what is in store for this market here?
Okay, so we saw a big sell-off overnight and into today, basically on relief that Israel did not target oil infrastructure in Iran over the weekend. Now, this action this weekend was in retaliation for Iranian attacks on Israel earlier this month, which was retaliation for Israeli attacks on Hezbollah. So we've been in kind of this cycle. There was a fear that Israel might go after the oil infrastructure or even the nuclear. So when they didn't do that, it was quite a bit of relief to the market and kind of pulled one of the main supportive elements in this pattern recently. It's eased concerns about interruptions to supply in the Middle East, even though ever since this conflict began a year ago, there have been no interruptions to supply. Now, the next thing that could be on traders' mind is the OPEC Plus plans to lift quotas. They're currently scheduled to begin lifting those quotas on December 1st. This itself is delayed a couple months due to lower prices earlier in this year. So the big sell-off today may cause them to postpone it again. Other big concern is Chinese demand. Of course, that's been nagging the market most of the year. When the market isn't rallying off of uncertainty over the Middle East, it's been pressured by slower than expected consumption imports in China, partially due to their sluggish economy, but also their move to EVs. Then we have stocks in the U.S., which aren't really burdensome. U.S. stocks, crude stocks, last week, 426 million barrels versus 421 million a year ago, but the second lowest in at least 6 years. Gasoline stocks also the second lowest in 6 years, and distillate stocks the third lowest in 6 years, but well below the 5-year average. So none of this is burdensome, which could be at least might ease pressure at some point, especially when we get through this concern about the next step in climbing a wall of worry over the Mideast situation.
Mr. Soderberg, last but certainly not least, what factors will be driving agricultural prices this week?
Well, I think the sharply lower energy prices overnight, driven by Israel's targeted missile attack on Iran over the weekend, set the stage for the lower trade here today. Weather-wise, conditions remain very favorable in South America. We've seen off and on rains now through central growing regions of Brazil all month, and it has enabled farmers to catch up on planting progress there. Soybean plantings, they've reached 36% as of late last week. That was up from 18% the previous week, and still slightly behind the historical norm, but certainly been able to narrow that gap significantly the last 2 weeks. Their first corn crop plantings, they've also reached 52% in line with the historical average. And recent rains here in Argentina, they've been labeled a game changer by the Rosario Grain Exchange in helping improve crop prospects there. Here in the U.S. drought conditions have spiked significantly across the nation's midsection due to lack of rainfall all this fall, but that has led to improved harvest conditions, which have almost run uninterrupted all fall. But we're expecting to see some pretty healthy rains across the midsection of the country this week, which I think should go a long ways in helping ease those concerns as we head into the winter months. So next week, of course, brings the U.S. election along with the USDA production and WASDE report next Friday. So I really look for prices to remain rather range-bound this week. I think these corn will find good support if we dip back under that $4 level, somewhere in that $3.90, $3.95 range.
range, the downside risk this week, and upside probably capped in the 4.25, 430 range. Nove Beans, I think, Jan Beans, I think they'll find some good support above its recent contract low, and I think any rally attempts will likely to be capped near last week's high at near 1020. I just don't see a whole lot of downside risk in wheat prices right now, with still concerns of the drought here in the winter wheat growing regions here in the U.S. along with Eastern Europe. So I think Chicago East does not have a lot of downside risk below 560.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.